So today I'm gonna let you kick off how you're seeing the world today, and then we'll turn it over to Salita.
Thanks, Mark, and thanks for the 36 weeks plus the excuse me, month or two we were traveling together beforehand, and also thanks to the community for actually listening to me for 36 weeks or the better part of it, and also for sharing their insights. And if you go back to just what's occurred the last couple of weeks, whether it was the session by Tom Jump, the one by Bill Deukler, Simons, Duncan's, or Sarah's, the insights shared are just phenomenal. So it is the community that makes this so successful, and today's program looks fabulous. So I'm going to move pretty quickly. Who would have thought that 9 months ago we would be talking about the market back at record levels and bullish sentiment at as high a level as we've seen since 2011, according to the AAII survey. So up at closing in on 50% bullish, which the question is, are we too bullish or not right now? This is another look from Ed Yardeni. I'm going to show a couple of slides from him on stock market bullishness going back back to the late 80s. This is the stock price, and this is one of the big questions. Where do we go from here, and what are we looking at? Ed Yardeni came out with targets the other day of, for the end of this year, 3,740 on the S&P, going up to 4,290 next year and 4,620 in 2022. So he's worried that rather than a pullback from here, we're going to actually have an aggressive melt up as one of the risks to the outlook. I thought that was an interesting perspective. That also contrasted back to 99 and today with a look at the Nasdaq. And I thought this was really interesting. The slow growth environment we've had for the last decade since the financial crisis has muted some of the upside. The Nasdaq is actually led by quite a bit, but compared to back then, it's a very different scenario. And these businesses are very different as well. They are not business plan businesses, but massive growers, and digitalization is one of our key themes for next year. One of the scary charts is stocks trading above their 200-day moving average, with 90% or more trading above their 200-day moving average in the S&P. Usually a bit of a discomfort to that level. So just quickly, are investors too bullish? At ARS, we focus on corporate profits, interest rates, and inflation rates as the basis for securities valuation. And we're looking at a rebound in corporate profits in 21, continuing to move up. We're looking at a pretty positive back to 19 levels, if not slightly higher. We think interest rates can move up, but not meaningfully. And while we've, as you know, have been in the deflationary camp and remain that way, we can see some pickup in inflation towards the second part of next year, but more so in the second half of 2022, which is a ways out. So we're not particularly concerned about that. But the general trend is positive for equities as we look at it. We think investors should really be focused on the secular issues. Digitalization is one of our big themes, but clearly policy is going to matter. The election in Georgia is going to matter. But we think that the dynamics of the economy right now will push us towards the secular themes, and that's where you want to invest. We believe that the benefits will not be shared equally. And next week, I want to show you what corporate profits are, cash flows, and corporate debt, and what the debt ratios look like. But the debt ratios are actually quite positive given the high levels of debt that corporations have taken on. But we think that it'll be a very uneven and favor active management again. And we still believe you should avoid the tails, the lowest valuation, highest valuation stocks. Some people got into the really beaten up stuff back in March, but not enough. I think this is a tough time to be going into either the highest or lowest valuation areas. We think cash positions and cash flows and manageable debt ratios will actually be a big push for the large companies and help a lot of the dividend payers do better. And some of the small cap companies will do better. And the market should be higher, but we do expect a pullback along the way, but we think we're in a bullish trend up. So Mark, with that, I'll stop.
Morning, everyone. It's a pleasure to be with you to share our UBS outlook for 2021. We don't have the slides yet, but I will tell you, we are calling 2021 the year of renewal. From a macro perspective, we see renewed growth in most regions of the world, with the US growing by about 4% next year, Europe about 6%, and Asia ex-Japan around 8%, all well above trend. And more importantly, we believe that growth will accelerate throughout the year as some of the pent-up consumer demand from recent lockdowns in Europe and certain part of the US is spent throughout the year. So, of course, the main driver of this acceleration is really the rollout of vaccines. We received great news throughout the past month, ranging from the positive efficacy results from Pfizer and Moderna to the actual rollout of the Pfizer vaccine in both the US and the UK. Our base case assumes that a majority of the US population is able to receive a vaccine by the middle of next year, and this pushes us closer to economic normalization. Now, given our view of rising economic growth, we see higher but not very high inflation. In other words, we see higher inflation than current levels, but only modestly, as there are still large components of the inflation basket that are experiencing disinflationary pressures, like rents, right? Rents will recover as more employers call workers back to the office, but this will take time. So we see year-on-year core CPI moving from where it has been this year, about 1.2% to 1.6% next year. Inflation should cyclically rise, but still remain below the Fed's target. In terms of rates, because we expect inflation to remain relatively subdued, we see the Fed on hold for the foreseeable future. Markets are not pricing in the first Fed hike until 2024, and Fed's willingness to tolerate slightly higher inflation means that the first rate hike will likely come even after inflation reaches 2%. So in this environment, we think 10-year yields can move slightly higher than where they are today. If the vaccine rollout goes really smoothly, we might be able to get to 120, 130, maybe even on the 10-year. But I would say, the pace of it is as important as the level, and I don't think it would be disruptive if it's gradually grinds higher. One final note on the market implications, maybe of the U.S. election outcome, which at this point seems like many months ago. So we see a Biden presidency and a divided government as a good outcome for equity markets, while we do need to wait until the conclusion of the Georgia runoffs to have complete clarity. And our base case is that Republicans maintain the control of the Senate. And with this makeup of government, we think that less market-friendly policies like higher taxes and regulations are off the table. And we've been encouraged by also the revival of fiscal negotiations and expect a relief package to be passed by the end of the year. So with that backdrop, maybe I'll just get to our views on some specific markets. Mark, I see you have them up here, so maybe we move to slide 2 here. Okay. So we see 3 major pillars for investing in the year ahead. I think, Mark, it might be one before.
Okay.
It's the one that has the 3 sort of pillars.
This is your 55 slide deck.
Oh, no. We sent like 10 pages.
Okay, keep
Okay,
going.
I'll just keep on going. I just sent only like, less than 10 pages. Okay, so we see 3 major pillars for investing in the year ahead. Okay, 1, diversifying into the next leg of the equity rally. 2, the continued hunt for yield, and 3, investors should position for dollar weakness. So I'll start with our view on equities and where we see opportunities. So going forward, right, we believe areas that underperformed in 2020 could outperform in 2021 as the economic recovery continues. And we see a preview already we saw that back in November when the market rallied, as the leaders were areas that lagged so far this year. Specifically, we continue to favor developed markets, small and mid caps over large cap companies. Even with the outperformance over the last month, US small caps still trail large caps by about 120 basis points year to date and are attractively valued on a relative basis. I think it's a similar picture for mid caps, which have lagged by roughly 350 basis points. And what we have seen this year, right, is a decoupling of small and mid caps from their traditional macro drivers like the ISM manufacturing index, inflation expectations, and the shape of the yield curve. So as the economy normalizes, we believe that these smaller companies should trade more in line with historical correlations and should catch up to the improvement that we have seen in these macro indicators. But we think that this decade will feature stronger performance outside of the US. So in terms of international markets, we stick with the theme of preferring markets that have lagged, like certain cyclical parts of Europe that should benefit from a rebound in trade. We also like emerging market value, which has lagged emerging market growth by about 70% over the last decade. The encouraging signs from the AstraZeneca vaccine are, I think, particularly important for emerging market countries. And this is because they have the largest agreements in place with AstraZeneca, given that their vaccine does not require extremely cold storage like Pfizer vaccine, making it easier to distribute. We also see emerging market value as an interesting opportunity because it offers an attractive dividend yield around 3% for those looking for additional income. And I know everybody is looking for income these days. So I think that's maybe a good segue to one of the major themes in our year ahead outlook, which is the continued hunt for yield. And we can go to that. Yes, that slide. Thank you, Mark. So even with an expected rise in global economic growth next year, we do not foresee a sharp rise in interest rates. And this is in part because we believe that the Fed will be highly sensitive to a rise in rates given the fragile state of the economy. And because we see a muted rise in nominal US Treasury yields, and also the prospect of rising inflation, we still favor tips over nominals. As we show in, I think, charts on the left on slide 4, with over $18 trillion of negative yielding debt at this point, most of which is concentrated in developed markets and is likely to grow with more stimulus, we think that emerging market dollar-denominated bonds offer compelling yields at around 4.5%. And also, this is maybe for investors that have a higher allocation to international, but even for US clients who venture out, Asian high yield looks particularly attractive with yields around 7.5%. We also think that private markets can help to enhance yield component of the portfolios for investors that are willing to take on an additional illiquidity and credit risk. Private markets, can provide enhanced yield opportunities through direct lending, core real estate, or infrastructure funds. So, there are still some opportunities, some interesting opportunities to generate income even in a low yield environment. We can turn to the next slide here. So I would say one area of the outlook where I get the most questions is on our view for weaker US dollar, given that it is down around 12% since the March high. And we think that with global growth improving, the demand for safe havens is likely to decline, which means further weakness here. And that's not to mention that continued budget and trade deficits are likely to weigh on the currency, while monetary policy remains extremely accommodative with the Fed on hold, as we discussed, and we showed it on the chart on the left on slide 5 here. So For US clients, the best way I think to position for this is to diversify some equity exposure to international markets. And even with the pullback more recently, we still view gold as a good way to hedge against negative real yields and dollar weakness. So that's sort of an overview of our thinking on the year ahead. But in our outlook this year, we also introduced a new theme around the next big thing, referring to segments of the market that would drive returns over the coming decade. So on this slide, you see that we've identified 4 areas where we see the greatest opportunities, which are fintech, health tech, green tech, and 5G. So I'll just spend maybe a minute walking through our thinking on each. Starting with fintech, right? We're seeing how technology is revolutionizing financial services, especially in payments. Consumers are using less cash and opting for more digital methods like contactless cards and mobile. The pandemic has definitely accelerated this trend as more consumers turn to online shopping when stores were closed. And we think that fintech revenues can nearly triple in the coming decade. On health tech, the explosion of telemedicine due to the pandemic has shown how new technology will help bring healthcare into the 21st century. Like looking over the next 5 years, we expect US telemedicine revenues to grow at a double-digit annual rate as health maintenance becomes an ongoing process rather than a once per year visit to doctor for most people. And when it comes to green tech, governments around the world from China to the European Union have committed themselves to achieving carbon neutrality by the middle of the century. And we see President-elect Biden's policies as an incremental positive as well. So achieving these targets will require substantial public and private investment. And we see opportunities in renewable energies like solar and wind, battery technologies, and of course, a greater role for hydrogen in industrial applications. Lastly, many of the innovative fields that I've mentioned would of course not be possible without the enabling technology of 5G. We've seen some 5G capabilities in new smartphones, but the application of 5G extends well beyond that, right? For example, the higher download speeds of 5G make some of the futuristic ideas that we talk about more possible. And this includes autonomous driving and remote surgical capabilities. So 5G really has the potential to revolutionize how we interact with technology in our daily lives. So maybe, Mark, I'll just stop there, and I'm happy to take any questions if we have time.
Since I know that you can't stick around as long, maybe we'll take questions on Salita and maybe what Stephen also hit upon, and then we'll move on to the panel. And quick questions on what we just shared.
Yeah. Mark, a real quick one. Salita, really like your comment about global growth moving people out of safe havens. And one aspect of that, I've noticed that the yen has had a remarkable appreciation over the last number of months. Typically, that's a safe haven currency. Do you have any thoughts on that? Sorry to come out of left field, but just curious.
Yeah, no, like when we look at our sort of our currency view in terms of diversifying outside of dollar, right? We're looking at each, and we see the most potential for euro. We're still waiting on the better news on Brexit, but yen is one of those where we think it's probably going to lose some of that appreciation because yes, it has a lot more of the safe haven. Safe haven characteristics to it, and it's one that our clients looking at, but it's not necessarily when we're diversifying outside of dollar, it's not necessarily one that we are heavily going into over the next year.
Thank you.
Okay.
Let me go on. We'll look at one before you leave. One was about what about stable coins as a store of value alternative to gold and US dollar, and your views on Bitcoin and crypto.
we are looking at it, but so far it's not something we have given serious thought in terms of a place that we would recommend to our clients. I know there's a huge following and support behind it, but we're still focusing more on the regular currencies and shying away from commenting on the Bitcoin, at least from the official perspective.
And what about gold?
Gold, so we like gold. Like I said in my comments earlier, I think gold is the best hedge against negative real rates, especially in this new monetary paradigm. Right, we're going to keep on seeing more fiscal stimulus coming, and also monetary policy supporting that fiscal stimulus, keeping rates low as long as they can, not just the short term, but trying to keep the curve as flat as possible to be able to make that financing cheaper. I think gold will have support behind it. And also, in an environment where we expect the US dollar to be weaker, that's also supportive for gold. We have seen gold reach above 2,000 this year. Maybe the gains in the near term might not be as high as we have seen in the last year. But I think even when we see the economic growth picking up this year, I still think the central banks will be accommodative. I don't see a big decline in gold. And I think, I believe portfolios should all have some allocation. There's going to be a lot of support behind it. It might be sideways for a little while, but I think for the long term, I'm a big supporter of gold.
Great. Well, thank you if you could stick around, please do. We have some other perspectives. One from Greg Schuler, who's the CIO from the University of Pittsburgh, runs a $4 billion plus endowment, as to how he's looking at 2021 and allocating. Greg, do you mind sharing your thoughts?
Yeah, thanks, Mark. I mean, if I could start off, I'll share one thought and then drill into it from there. I would say we're very optimistic about 2021, and I think that's feels uncomfortable given everything that we've seen in the stock market over the last 6 months. But I do think we're at the very beginning of a rotation, and I wouldn't say it's as simple as value versus growth. I think you have to drill down way deeper than that. And I worked at Sun Microsystems during the tech bubble of 1998 to 2001, and I do think there's a lot of analogies now. We clearly aren't at the same valuation levels, but I think the IPOs that we've seen over the last 2 weeks, where we're approaching 50 times sales, is starting to move towards what we saw in 1999. We clearly saw things at 100 times, but I think as we move towards 50, I think clearly we're at elevated levels that are totally disconnected from fundamentals. And I think the biggest sign of this is the fact that we see companies discontinuing IPOs last week. I think that's a very important signal. And so I think the rotation that we're positioning ourselves for is the movement away from the big winners in technology into the consumer cyclicals. And I think there are some very broad areas of opportunities in consumer cyclicals. I think casinos are a great example. Wind's very cheap. We all know airlines are very cheap. The cruise lines still are extremely cheap. Financials have seen a strong rally, but I think they're relatively cheap as well. And so the play that we're pushing very aggressively in our portfolio is this rotation away from expensive tech into more consumer cyclical stocks around the world. And I would echo Solito's view that emerging markets is very attractive, and we're pushing this theme very aggressively into emerging markets as well. So that's the optimism we feel in the short run. I think we have a longer term level of optimism too in what you would call green tech. And we think there's two very important themes that we're going to focus on in 2021. One of them is the continued transition to natural gas driven technologies. That could be something as simple as a cogen power plant in emerging markets, or it could be the conversion of natural gas into automobile fuel, which is an investment we made last year, and we're going to continue to look for those themes. I think the other one is around efficiency and the continued drive in the near term to improve economic efficiency to lower greenhouse gas emissions. We think that's another very important theme that we're pushing very hard. So, but our big prediction for 2021 is the continued rotation we've seen over the last month away from expensive tech into more consumer cyclicals and the returns that'll drive both domestically and in emerging markets.
That's great. Thanks, Greg. Let's move on. Mark Yusko, if you could take the stage and share your views on 2021.
Yeah, sure. I always say I hate to be the skunk at the garden party, but I think the optimism is probably a little over ebullient. Yeah, I think Greg's exactly right. The similarities to 2000 in the public markets, the public equity markets are pretty extraordinary. In fact, we're worse than 2000. There are companies trading not at 50 times sales, but at 400 times sales. Now, my son happens to work for that company called Snowflake, so I'm not really unhappy for him, but it's silly for companies to sell at, the company we're using right now, the product we're using right now, Zoom, trades close to 140 times sales, not 140 times revenues. Times earnings, because they actually don't have any earnings, and there's no prospect of having earnings in a lot of these companies. I won't even go into Tesla, which is a cult in and of itself. But I think the economic recovery is falling flat on its face all around the world. You're seeing that in all the leading economic indicators. You're seeing it in interest rates. We have the highest level of negative interest yielding bonds in history, over 20 trillion. Just let that number sink in for a second. And remember that a trillion is $1 every second for 31,710 years. So $20 trillion of government bonds have negative interest rates. And one of the things I think that's happening, and we actually completely agree on the negative view on the dollar is toast. The Fed has declared war on the US dollar. It's the only way out, right? When you have excessive debt, which every Western economy has, you only have 4 ways out, right? You can pay back the debt. That isn't going to happen. You can restructure the debt. That's not going to happen because you'd have to have somebody accept the restructuring. You can default on the debt. That's not happening because then the people in government get kicked out, or you can inflate it away. And that's exactly what's happening. And so there is a race to the bottom all around the world. Every currency is being devalued, except the hard money, which is gold and ultimately Bitcoin. And the money illusion that's going on, right? The nominal value of stocks appears higher, right? So over the last 3 years, since January of 2018, equities appear to be higher, right? They're up about 4.5% compounded over that period. 4.5%, that's a terrible return. Well, yes, it is. And it's worse than that because that's only denominated in dollars. If you denominate in real money, gold, you're down about 20%. If you denominate in Bitcoin, you're down a lot. Best performing asset this year, surprise, surprise, again, is Bitcoin. Up 170%. It was the best performing asset last year. It was the best performing asset the last 5 years. It's the best performing asset the last 10 years. So that's not true. Over the last 10 years, it's collectible Porsches, which is actually really interesting because they're very scarce and only Jerry Seinfeld and Jay Leno can afford to buy them. But I really think the idea that we're going to have a global recovery when lockdowns are accelerating. We're about to go into total lockdown in New York City, right? They've just banned indoor dining. California, massive lockdowns. So I think the challenge for investors is going to be in a world where interest rates are not going to rise, they're actually going to fall. They're going to trend to zero everywhere in the world. So long duration treasuries, particularly long duration Chinese government bonds, might be one of the best investments going. And then you look what's going to happen to equities at valuations that, again, on no normal level of analysis could you justify. The S&P 500 today sells at 37.4 times earnings. It's never traded at that level, and that's trailing. And everybody says, oh, earnings are going to recover. Well, earnings likely are not going to recover dramatically. They're down about 13% this year. And while, again, I completely agree with Greg that there are segments and pockets, particularly in value, that are extremely attractive. Energy, traditional energy, might be one of the best performing assets over the next 12 months by far. There's some incredibly cheap assets in that space. And fossil fuels are not going away anytime soon.
Mark,
Even if
sorry to interrupt, I just want to keep a few more people with perspectives. But
oh, sure.
You're like a freight train that could just go keep going. And I love
All right,
it.
I'll leave you with one word, Mark, and that is digital assets, or I guess that's 2 words. Digital assets is the big trend for 2021.
Fair enough. So let's Fred Greer, sitting in Roanoke, Virginia, running a $2 billion pension as he tries to steward that capital. If you could, your view on 2021. I'm gonna do my David Letterman. You're on mute, and then you're still on mute.
Thanks, Mark. We're generally bullish going into 2021. Similar to comments from Greg as well, seeing some analogies to the late 90s. I think one big difference today is the level of interest rates. So the 10-year Treasury is at about 0.9%, 30-year 1.6. At the end of 98, the 10-year was 4.7, 30-year was 5.1. And then you have the stimulus from the government as well as the vaccine distribution. And I think that is probably one aspect we think is maybe underestimated, just the pent-up demand and excitement people have about going back to a normal daily living, going out to dinner, vacations. We think that's going to help propel the markets up. I think it's going to be one of those scenarios where, people recognize valuations are stretched, but they could get stretched further before there's a turn down. I think also the rotation aspect. We came into this year with a value bias that hasn't worked. We started to see a rotation in November. So in the U.S., the Russell 1000 growth is up 33% year to date. The Russell 1000 value is up, it's flat, basically up 0.2%. And on the international versus US, the S&P is up about 14% this year. The IFA, developed markets outside the US, is up 3%. So we think there's going to be rotation into international and continued rotation into the cyclicals, particularly as valuations are high in general. As investors start to scrutinize valuations more, there's probably going to be more interest in international markets and value markets, both of which have underperformed kind of the broad US in the last several years. And we're focused on the private side. We have an allocation of approximately 25% in illiquid investments. We actually have that tilted more on the fixed income side, given where yields are. And on the equity side, we're focused more on early stage venture, as opposed to buyout and late stage venture, where we think there's more crowding in that space.
So I don't see Esther here at the moment, but let's carry on to you, Eric, playing a little bit of a cleanup role, which really, you whether you go first or last, you're still going to speak your mind.
Well, I just got done. I sold everything and bought Bitcoin and long Chinese government treasuries based on Mark's freaking me out there with that input. So just actually, and Mark specifically responding to that and to some of the comments about interest rates and government debt policy. I'll just kind of I'll give just a personal perspective and like a dumb story, which is I love economics and have always acutely tried to understand what these government macro policies and levels of government borrowing are going to do to the economy and to my investing. And I've been interested in that for more than 25 years. In 1994, I was a brand new second-year analyst at the Blackstone Group in the very early days there. And it was small enough that I got taken to lunch by Pete Peterson, who, of course, was chairman of that firm. And he had Henry Kissinger along with him. And we had lunch at the Four Seasons, the old Four Seasons restaurant on Park Avenue. And I remember vividly 40 minutes of those two individuals, of Kissinger and Peterson, giving this absolutely draconian lecture about the Clinton administration's grossly irresponsible government debt policies that were going to sink the entire U.S. and global economy if budget deficits and government debt levels were not arrested. And I believed it then, and I was super cautious, and I've always been super bearish about irresponsible government spending and government borrowing. And I am here, 25, 26 years later. And it seems I only point out that in my experience and looking back many decades, there are incredibly smart prognosticators. And I continue to give kind of the same overall caution about particularly the stimulus spending in the US and in the West. I mean, the amount of debt that's being incurred is completely bonkers. I continue to wait since 1994. I've been waiting for the other shoe to drop on irresponsible government borrowing. It doesn't seem to happen. So there's almost something that seems a little mysterious to me, is that how the hell these governments continue to meander on year to year and engage in that behavior. Mark, a couple of other just sort of macro comments. I said this a little bit earlier. One thing I would point out is, and you can observe this analytically in some parts of the United States today, that I think we all humans tend to underestimate the tendency to return to the mean, to return to familiar and normal behavior that is deeply built in. How many times have we all heard, this is the new normal, everything's gonna be on Zoom or whatever the hell it is. It's right, like all the time you're hearing this. There's a lot of pent-up demand in a lot of consumers to return to going out, going to bars, going to restaurants, going to Disney. I am not a big, robust optimist about what's going to happen with spending into 21, 22, but I think that there are going to be selected consumer sectors and areas where there's going to be a big return to spend into specific categories in the economy. But I couple that with two negatives personally. One is that, and it was interesting, Salita made the comment earlier that UBS says that a divided Senate is going to constrain the Biden administration's ability to implement more business regulation. I have a different view, which is an awful lot of that is done by executive order. And the Biden administration is clearly coming in feeling they have a mandate to undo a lot of the Trump era deregulation. I think you're going to see a lot of business regulatory implementations that are going to arrest particularly small and medium-sized business growth. And I'm also, I still wait for anyone to show me what are the macro drivers of growth and economic efficiency that we could look to in the US and developed markets that are going to be really creating intrinsically new wealth and spending. I think those opportunities are limited. So I remain very bullish on individual categories. I think you need to be very selective. Everybody who's heard me before, will hear me say, cannabis continues to be an area that there is simply intrinsic growth and demand in a radical change in the regulatory environment that is going to accelerate. You have 68% of American adults now say they favor legalization. That is a tidal wave of behavior change that is going to impact a lot of growth in cannabis, but also a slowdown, I think, alcohol, tobacco, pharma. I would be concerned about cannabis's impact on those categories. And Mark, I'll wrap up with this comment. And this is kind of a social comment. We haven't talked about this at all from an investing standpoint, but I think it's super relevant to every person that receives information in the modern era. Mark, I said my word for 2021 is disinformation. And the reason I say that is not fake news, that is not right, left, or anything else.
You've been saying that since March. because
I've been saying that since
I have all
March.
these recorded.
And it is recorded. I will continue to go on the record. And I'm sorry to pick on people. Jeff Zucker, Suzanne Scott, these other media executives, they are going to make their bonuses in 2021, 2022, 2023. And people do not realize the extent to which all forms of information delivery globally have become for-profit businesses who are focused entirely on saying and doing anything necessary to drive increasing ratings, increasing viewership, and increasing revenue for themselves. And it's a really disturbing amount of skew, in my view, that is creating this perception of polarization and like social meltdown. When you actually look at the statistics, and humanity today is actually in a position of unparalleled, unbelievable success that we should be celebrating, not angry at each other.
What are the questions for Stephen Burke, Salita, Mark, Greg, Eric, Fred?
Hey, Mark, it's Rob Colorini here. Just a quick thought. I think we talked last week or the week before on Airbnb, and that IPO turned out to be 3 times the 33 billion valuation I think we were talking about. I think reflective a little bit of Eric's comments of the consumer spend. Do any of the panelists have some thoughts on that in terms of either the community seeing sort of light at the end of the tunnel on that, or does that touch other areas like real estate and the consumer confidence side?
Rob, let me take that a little bit. That I actually don't think the stock price outcome reflects anything to do with reality. I mean, I clearly think that Airbnb's business is recovering. And it actually has been, I stayed in an Airbnb for 6 weeks, drove out to California to see my daughter when she was having her baby, and, no problems at all. So I think that business model is fine. The challenge is, the valuation of the stock is silly. And it's like other silly valuations. And I think the problem is we've dissociated 4-letter ticker symbols from companies. We got the guy Davey Dave, day trader, pulling Scrabble tiles out of a bag and buying the stock, and people buy it too. That's not investing. That's silly. So I think that's what's going on. Is we have a lot of liquidity. We have it chasing a small number of quote unquote can't miss companies. But Howard Marks has a great line, right? There's no investment you can't screw up by paying too high a price. And someone earlier, I think Greg, you were saying you worked for Sun Microsystems, right? There was a time back in 2000 where Sun sold at the lofty level of 10 times revenues, and the CEO came out and said, "Look, to make an economic return, paying me 10 times revenues, I'd actually have to give you all of my revenue for the next 10 years." Which is kind of hard because I have employees and I have to pay taxes and I got cost of goods sold. And the stock went down 98% over the next few years. And that happened to a lot of stocks. Cisco was 286 times earnings, went down, 94%. So that's coming. I can't tell you when, but these valuations are at levels that are incomprehensible. And the argument on interest rates justifying the higher multiples breaks down when you get below the whole Fed model idea, breaks down below 2% interest rates. Think about it. Low interest rates are not a sign of economic prosperity and growth. They're a sign of economic weakness. Name a country in the world that has strong economy that has low interest rates. You won't find one.
Hi, Steve McCarthy, Mark.
Wait, 1 second, Stephen, Salita, let's let her quickly answer.
Yeah, I just want to jump in, not specifically on Airbnb, but on the IPO market. I think, I have a little bit of a different view in terms of whether we're in this bubble or whether it's better or worse than 2000. I don't think that the IPO market, I think it's very different from the craze that we have seen during the .com boom. Clearly, we got a lot of attention with these names. I think on average, the first day return this year on these IPOs is about 45%, and it's the highest since 2000. So I certainly understand the worry about it, but I think there are a couple ways that I see how it's different than the craziness in 2000. So first of all, the volume of IPOs going public today is much lower, and the characteristics I think are very different. We've done some work recently around this. So in the lead up to the dot-com bubble, there were over 400 IPOs each year. Now it averages between 100 and 150 per year. And these companies are much older on average, around 10 to 12 years, compared to the maybe 2 to 3 year old companies going public back then. They're also larger and more established. I think companies were going public after 2 rounds of VC financing in 2000. Today, they have 6 or 7 rounds before they go public. And I think the second difference is a smaller number of companies means that they face much tougher investor scrutiny. We've seen those bigger names with questionable business models either have their IPOs pulled, like WeWork, right? Or the market reaction has been more muted, like in the case of Uber and Lyft. And the last point I want to make here is that economic growth was much stronger in the late 90s. No one was talking about secular stagnation. And that's the dominant macro narrative today, right? Which is why the demand for growth stocks has been so strong for the last 5 years. This could change if we see a sustained rise in global economic growth. But until then, I think tech and growth stocks will continue to have a strong bid from investors, which means demand for IPO stocks will probably stay quite high for the foreseeable future. So a little bit of a different perspective of what might feel like 2000, but there are differences.
Salita, can I ask you a question there? So I don't disagree with the point that that people are buying these assets. There is demand. So I'm not disagreeing with that at all. But help me with the economic rationale. Let's take Snowflake. What's the economic rationale to pay 400 times revenue for a company that lost $350 million on $250 million of revenue, and now is got a valuation of $140 billion? Help me with the math, just the analytics of how I can ever, as a shareholder, get a return on that investment.
No, I hear your point on a company by company basis, maybe, and I'm not looking specifically. I'm not analyzing individual companies. I have analysts that do that, but I can't speak to it in this case. All I'm saying is the market itself. The question about the bubble seems a little bit premature. Maybe we will get there, but over the next year. But at this point, there are a lot of differences compared to a period that we remember as a bubble. The economics on this company, I'm not looking, like I said, specifically to Snowflake. Maybe the rationale is not there for Snowflake, but maybe for Airbnb. I'm a user of Airbnb. Maybe there is for Airbnb, right? So I mean, we can analyze one by one, but I still think that there's time for us to shun the entire market as a bubble.
So thank you, all of you, for your comments. I really appreciate that. From Salita's, I appreciate the last point, which is, the macro veneer that's over the market that may be clouding the individual performance behavior. Eric, I think your comments regarding Dr. Kissinger and Pete Peterson bring a very practical view of the world is long lost. And certainly, Mark, I agree with your comments. So as I sit and I think about 2 data points, some data point in February of 2020, pre-coronavirus.
Jim, because I love you and know you, you got to really hit it because we have to transition.
I understand. To the data point of today, and other than emotion that we think we have a vaccine, what's the difference, right? The market is at an all-time high, and the fundamentals haven't changed at all, other than behavior, and especially the behavior as we're entering into the largest phase 3 clinical trial without a control study and having no clue what's going to happen when we find out that people with kidney problems or heart problems or are going to be negatively affected, and people are going to die because of this panacea. It's not a wooden stake. So I don't know who takes that, but I'm trying to get my head wrapped around this.
Who wants to take that quickly?
I'm just going to second that emotion. We have no data on safety or efficacy.
Can I say something about the vaccine for a second? It may be a few years since I've gotten the data on flu vaccines in general, but if I'm not mistaken, at least up to 2015, no flu vaccine had ever gone through an FDA trial. It never had a control because every year the vaccine is completely different. So we have to keep that in mind. Thank you.
So let's consider that a question, not the answer right now. I know Mark and Stephen, you had some questions, but I want to keep us on pace. We do get together every Tuesday, as you know. We can continue these discussions. I'm going to hit a button. We're all going to go to breakouts, and I'm asking you. We'll take 3, 4, 5 minutes to get. And I'll put on the screen, how it works, and maybe you all remember. But this time around, it's we get together. Still about introductions and your asks, because that's sort of what we do all the time. That's our messy, magical thing. Who's looking for what, capital deals, whatever. But focus on a prediction as you introduce yourself, your point of view, whether it's Bob Winspear and sitting in Dallas, and it seems like everybody's moving from Silicon Valley to Texas. You can talk to that, whatever it is. People in Singapore are saying that we have more tailwinds than headwinds than you have, and all the rest. But I'm going to hit a button. We're going to let each other interact as we do. Let me go back over here. 1 second. And we'll come back here, and at 12:30, we will have an opportunity to get back and talk about the foundation bits, and then exchange everything in a town hall debrief. So with that, I'm opening the rooms. You're all being assigned. Welcome back, everybody. Waiting for all the rooms to close.
Hi.
Okay. So room by room, I'm just looking at you, Greg, because you popped up. Seems like your prediction won favor. You want to? Who's sharing it? You or someone else?
I think it's Mark. Mark, you want me to go or you want to go?
Go for it. It's your theme. Go for it.
All right. So I think it's the continued theme of cyclicals winning out here, and it doesn't necessarily have a short tech against it, but it's consumer demand will be much stronger than expected in the second half, and that'll drive all cyclical sectors such as energy, travel, hotels, restaurants. So it's a theme of cyclicals outperforming significantly the rest of the market.
Is there a debt play for this too, or this is all pure equity?
No, Mark, we're greedy. We're going all equity here.
Okay. All right, that's Greg's room. I'm looking at you, Charles, but I don't know who's speaking for your room. You're on mute.
Sorry. We kind of went and took a tour around the world. We kind of talked about a lot of different things. Talked about blockchain and cryptocurrency and their relevance in today's space, how in the accounting world, this new paradigm of COVID-19 impacts the economic environment, and just talks about how athletics, professional sports, that the valuations, if they are impacted by the COVID environment. I told them, and I think Richard was in the room as well. He says that the valuations are still higher than ever in professional sports. We do feel as though because now there is a vaccine, they will bounce back and generate as much revenue, if not more, than when they started because of, I mean, people want to get back out and get back to some sense of normalcy. And I think fans will better appreciate now going to games and actually seeing live events as opposed to watching them on TV.
How about that Browns game?
And that was one of my best case examples here in America. Football. That's why football is number one, because you get only one exciting game per week to see. So it makes you you can't wait till next Sunday. So you have 7 days in between the next event. So that's exciting.
Who's next? Just raise your hand and go for it.
Well, this is Rob here. I'll start off, and then to have gender diversity, we'll have Andrea kind of close. But we were really lucky to have Fred on our in our breakout from the hospital system, because we started off talking about on COVID community, and even just the mentality within the hospital system, and we even got further talk about vaccine. The dialogue on cash position came out from Dave in Seattle for both, different organizations and then personal, looking at things. And the Airbnb situation came up of let's say richly priced situations, but the fact that a lot of us have not been going out and traveling, and there's a little bit of cash stored up that can be used opportunistically for growth or for mispriced type assets and the roll up. I'm going to shift to Andrea a little bit on technology and SPACs and fossil fuels. Andrea.
You're muted, Andrea.
Oh, okay. Here we go. Along the lines of the IPO vis-a-vis Airbnb, we also touched on SPACs and how this year, I think more capital has been raised with the SPACs, over 100, than the last entire decade combined. But there wasn't a consensus among the breakout group, that a bubble is around the corner, presumably because there's so much capital. But the sort of counter against that is, these big tech companies might be broken up and might sort of shake the market quite a bit. And then we also touched on fossil fuel, and how even if some of these big oil and gas companies have to divest, including the Rockefellers, but they did it on their own, whereas others may be required to do so. I don't know that they'll be hurting as much as we might think, because they hold on to a fair amount of green tech, the green tech IP. So just as, when Standard Oil was broken up, they ended up, having sort of multiple companies and ended up making more as a result. So not sure what this means for big tech companies, should they be broken up, but it remains to be seen. So we don't really have sort of a definitive prediction as to what's going to happen, but these are some open questions.
Great. And who's next? And by the way, I'm buying time because Salome, where she is, she has an alarm. So
hey, Mark, before you go to the next one, can I just second the emotion on SPACs? SPACs have become the number one way for high growth companies to go public. We think the SPAC trend is got a lot of legs, and there are multiple ways to play SPACs. And if anyone's interested, reach out. We've done a lot of work here.
Do you have a SPAC in the works?
Well, we have a SPAC plus fund that does SPAC arbitrage, and then we are actually launching a SPAC ETF in January.
Seems
Mark,
like
how do you feel about the valuations on the SPACs relative to other investments that you're looking at?
SPAC valuations come out significantly lower because you're having to, it's a good old fashioned, minority stake in a real business. There are certainly bad valuations in the SPAC space, the ones that have gone up 40, 50, like DraftKings, right? We invested in DraftKings in the pre-IPO. At $20, it was expensive. At $60, it's crazy. But you make a lot of money when it goes from, $10 to $20. So, but there, in every segment of the market, there are excesses, but SPACs overall, valuations are significantly lower.
Thank you.
So who's next?
I'll go.
Go for it.
Hey, Mark. Yeah, so Jerry Connolly here. We were in breakout group number 4. We had Doug Jones, Mark White, and Torin Kutnick. All some very, very interesting and robust discussions. I'm going to let Doug talk about his unique insight, but we talked about real estate, multifamily, retail. We talked about solar power, alternative energy delivery systems, and then we talked about healthcare tech, ag tech. All very, very good ideas out there. Torin talked about, the best place to be right now is probably alternative energy delivery systems. And he talked more specifically about solar power. Mark White has his own early stage VC company, not only representing money, but also consulting. And his whole thing is healthcare tech is going to be sort of the unifier of a whole ecosystem, which I think makes sense. And I'm going to turn it over to Doug Jones because out of everybody, we all agreed that he gave some unique insight into the real estate market that we all were not aware of. Over to you, Doug.
I vehemently opposed this idea because I thought that, it doesn't really go with everything. I think all of them were in health tech. And so my idea was so mundane that they thought it was unique, I guess. But what we see in the real estate that I'm invested in is that people are making it through in a variety of ways. And, we were quite shocked to see how many not-for-profits stepped up to help people make their rent payments and how retail tenants, also managed to make their way through as well. So it was just a different, kind of a short view of what's happening just over the next 6 or 9 months until we get past the vaccine, I guess. But really, at the end of the day, I think our group thought that health tech was a sector that had a lot of upside and had so many different angles to work on. So leave it at that.
Fair enough.
Yeah, I was in a group with Allison Smith, Mark Jarvis, Rich Sobel, Pedro Blanco, and Dominic Ward. There were a lot of thoughts about how difficult. My conclusion is how difficult it was to figure out where to invest, because Allison saw that there were a lot of uncorrelated assets and valuations, and it didn't tie together into one holistic view of widespread economic growth. And then another topic of conversation that we focused on quite long is emerging markets opportunity. And there seems to be the view among Mark and Rich that emerging markets is not a sector opportunity, but it's as well as Pedro, but it can uncover pinpoint opportunities, especially if these companies are focused on global macro tech trends, for example, and they're replicating a technology in a new market, an existing established technology in a new market. Leapfrogging within that microcosm could cause really great returns on that company's value. And then Dominic had a lot of great things to say about crypto and how it's become an institutional asset class and a real store of value, similar to gold in a lot of places around the world. And Allison, you were going to back me up, so I'm going to let you fill in what I missed.
No, I think you did a great job.
Great. Who's next? And Zach Nasser, keep me apprised of on Solomay. Maybe we'll let her go last.
I'll go next, Mark. We had a really great group, fun conversation. Kind of like two sides to our conversation, actually. The first side was a little more philosophical in the sense that we were discussing almost like in 2021 on the back of COVID, the business case for humanity as a service with this kind of desire towards and looking towards social impact, recognizing what we talked about last week on our own panel, the empathetic nature and the generational shift that's happening as consumers and as with extraordinary buying power, how do you wrap all that up into looking at ways and companies and products and services that truly look to amplify humanity? So we were discussing the in-depth nature of that as a business case for 2021 and what could that mean? I think we were kind of generally agree, we were kind of tepid on the excitement over the ability to get back to normal as the vaccine has more of an elongated trunk and rolling out. On the asset side, I think we all agree we're definitely long on digital assets and the viewpoint for 2021. And we had a pretty robust discussion around the idea of valuations, and on the back of the conversation on Airbnb, how disconnected are traditional equity valuation methods from companies of today that are coming to market when you're not investing on the multiple of revenue or earnings, but you're investing on the absolute massive potential for scalable growth. And not only is it scalable growth, but it's new markets. So we talked specific about Airbnb displacing revenue from the hotel industry. But it's not simply the case it's displacement of revenue, but it's also new revenue for people that love the use case of Airbnb because it's a personal experience. So I may not have stayed at a hotel previously, but I will do an Airbnb. So what is that untapped potential and growth there? And then how do you evaluate such a thing and justify what seems like a crazy valuation like the Airbnb came to market and getting comfortable with that, and as recurrence for equities coming to market over the future? So that kind of wrapped up what we had discussion about.
Thanks, Denise. Who's next? Don't be shy. At least 4 more rooms. I do want to hit on the philanthropy out of Salome is back on. But quickly, who else? Vladimir, do we have your room done? We talked about Sudba. Anyone know the Russian word Sudba? It's means fate. Yeah, of course. You were on. Why did I use that expression, Vladimir? You're on mute.
Yeah, no, sorry. What's the question?
I used the expression Sudba because you had connected with somebody.
Absolutely, with Daniel Wolf, right? So, I'm a Russian in Saudi Arabia. There is another, I guess, American in Russia. So this is kind of a connection.
No, I think it was also, this is Cam. I sent a text to Vladimir when he asked a few questions on the chat. And then later on, I end up on the same room with him. So then you came in, Mark, and you said, this is Sudba, means fate.
Fate, okay. So who's next? Was it have you guys gone yet? I think you did, yeah. Who else? Because I want to talk about one thing really important. Has everyone spoken? Yeah.
Room 7 hasn't gone yet.
Okay, Trevor, go.
It was really led by Stephen and some economic thoughts, but while it veered around the world, I think we spent probably half to 2/3 of our time primarily on the idea of what is the consumer going to do and how is that going to tip off investment strategy with vaccine versus, prospective permanent changes for work from home, to the social dilemma, to how will office work look in the future, etc., and trying to take the cue off of, and by the way, not knowing the answer yet, what will the consumer do, and then how will that veer its way into how we invest in the, well, I guess in the short to medium term, and then potentially in the long term.
So more of a question than an answer.
Yeah, more of a bit of a a fun debate.
No, it's which is fine. Maybe that's the make of an event we should do. Anyone else? I want to sort of have Zach and Sarah show spotlight. But have we done your room yet, Sarah?
That was Denise.
Okay, you were just extra quiet.
I know, it's shocker, right?
Yeah. Okay. Anyone else before we turn to the? And I don't see Salome on here yet, do I? So Zach, you and Sarah want to I've got something, I'm just going to flash, and if we miss anybody, let me know.
You want me to go with it?
Yeah, I was just going to also, Zach put some interesting slides together, or there's two.
Oh, go ahead, Zach, you go first.
Zach, go ahead.
Yes. Hi, everyone. This is just like a quick recap of all the philanthropy efforts we did this year. And not just this year, like it serves to show that within 361, impact was an interest from a long time ago. I mentioned that the root of the trees here, we had minus bio and clean fiber. So there are things we worked on several years back. Manus is like really important for sustainability. What they do is like a process to produce ingredients without the agriculture part, like directly create like fragrances and flavors and whatnot. Clean fiber is like recycling corrugated,
Aaron Ellsberg is smiling.
Yeah, into insulation, like really quickly on that. So these are just two examples, but there's a lot of like sustainable and impact investments within the community. And then on the right side, you see some of the events we had this year around different topics, whether it was mental health, education, water. We had a cocktail mix event one time where we had like someone talk about amputee athletes. We had someone talk about Africa and like other topics. In a bit, I guess Sarah will talk more about the kickoff event for 361 Foundation, but that's something getting set up now. Besides that event, it's basically a vehicle for more philanthropy collaboration in the group. So it could be like doing some grants, doing some events and whatnot under like an actual foundation umbrella. And we're open to more ideas also for the foundation. This is just the beginning. If you could go to the next slide, Mark.
Yep.
So the event, Sarah will talk about that. So the one with Jerry Rice. I want to just comment on the right side, which is based on members' interests, like within 361. So you could also fill this in the app, I think, so that we have more of your interest areas within philanthropy. So these were the biggest areas chosen. Actually, out of everyone that's filled their profile, and it's around like based on 60 people, you have no poverty is like the most important thing. Everyone cared for that. So we'll try to have events around that area. And again, like we mentioned before, if you have existing foundations or charities you work with or you founded, tell us about them, your expertise areas. We'll collaborate in those areas.